Traditionally, you would expect tech stocks to make up around 15% of a portfolio, alongside 10% for finance, 10% for healthcare, industrials, and so on, for your portfolio to be considered diversified and equally weighted. As a result, it would end up looking something like this. However, times are changing, and tech is starting to move out of its own sector and is taking over others. So do we need to adjust our portfolios accordingly? Let's find out. Hello, my name is Henry and welcome to Channel MI, the brand new Millennial Investing channel which is all about sharing my investment journey with you by providing regular updates on my portfolio alongside my views on stocks and emerging trends in the market. Before we get started, I would really appreciate some support with a like and subscribe to try and help this new channel get off the ground. If you subscribe, you'll be one of the first ever subscribers on this channel and will be right with me at the start of this journey, which I plan on documenting for a long time to come, so thank you. Today we're going to be talking about tech stocks, or more specifically, the value of tech stocks within a portfolio. Traditionally, tech stocks have largely comprised the FAANG stocks. For those who haven't heard this term, it refers to Facebook, Apple, Amazon, Netflix and Google. You would probably also add Microsoft to that, but clearly it messed up the spelling. Lots of people are really concerned by their portfolio weightings and having sufficient diversification, me included. But I've started wondering whether traditional stock weightings are becoming outdated, and that tech has now broken out of its own asset class and has started taking over some of the others like finance and healthcare. It could lead to many portfolios looking very different in 10 years' time. Now, I have watched a lot of portfolio videos on YouTube and can usually predict which companies most people are holding in each category. You'd have 3M and Boeing for industrials, BP, Shell, ExxonMobil in energy, and all the big banks, JP Morgan, Barclays, Bank of America in finance. And don't get me wrong, most of these companies are fantastic companies and I hold a lot of them myself. But I also think we need to be looking at more innovative and disruptive companies in each sector. So to show this, I pulled together 3 examples where we are either already seeing industry disruption or where it is at its very early stages. And we're going to start with finance. Finance has historically meant banks, traditional banks that loan capital and mainly take their money through interest rates. They are one of the most established sectors within the world economy, but there is a growing concern that they are on the verge of being disrupted. Fintech companies like Square and PayPal are rapidly growing market share and are beginning to take customers from traditional banks. Square, for example, started out as a financial merchant which facilitated payments via mobile devices. But since then, they've developed a cash app where money can be deposited and held in an account, just like a bank, in addition to developing Square Capital, which basically provides loans to customers, mirroring the traditional banking core business. And the problem for banks is they are doing it better, because they already facilitate certain customers' payments, meaning they have detailed data on their transaction history and revenue information, something banks would never be able to gain access to, let alone analyse, making them much more informed about how much to loan a customer and whether they are good for the money or not. My view is the disruption in the banking sector is in its early stages and still has a long way to go, but I do expect to see fintech stocks continue to grow, and it's definitely a trend I will be keeping a close eye on. The second sector I've chosen to highlight is the automotive industry, which is already well advanced in terms of new disruptive technology, primarily led by Tesla. Tesla has been developing technology for electric cars since 2003 when it was founded, focusing on developing cheap, scalable battery production that can power cars further and more efficiently than the traditional combustion engine. This week they announced they have now developed the technology to carry an electric car 1 million miles, making it a substantially cheaper alternative to traditional cars. Every other car manufacturer is miles behind Tesla in their technology and is trying desperately to keep pace. Tesla car sales in 2020 were higher than any other car model, signalling their newfound dominance. And to demonstrate this further, whilst all traditional automotive companies' share prices are at near historic lows in some cases, Tesla stock hit $1,000 per share yesterday for the very first time, up nearly 400 to 500% from the start of the year, which is absolute madness. If we look at the charts here, you can see start of the year, about $300 a share, went all the way up to the mid-90s. COVID hit and they dropped down to the mid-300s and have very quickly recovered from there up to reach the all-time high of over $1,000. How far can they go? I don't know. Some analysts think they can go a hell of a lot higher, $5,000, $6,000, $7,000, $8,000 per share. People forget Tesla aren't just a car company; they are a solar, an energy company. So they have solar panels, they have their battery storage. So the renewables side of the business is also growing really, really well. The third and final industry I wanted to highlight as having experienced significant disruption is the energy sector, one which is very well documented. There is clearly a shift taking place towards renewable energy, such as wind, solar and electric, which has meant decreasing the demand for oil. As electric cars continue to gain market share, this demand will only continue to drop. The big oil companies have taken a battering during this crisis, and Shell even cut its dividend for the first time in decades. For me, that signals a turning of the tide away from oil, and I think the pandemic will accelerate that process. I don't currently own any oil stocks in my portfolio, firstly because of the changing market trends as just mentioned, but also because of the market dynamics, meaning companies have no control over their price, the price of their oil, which can be sold, leading to huge levels of volatility. I am expecting and hoping renewable energy companies will continue to grow, like NextEra Energy and Tesla shown on the screen, but also First Solar and a number of others. I understand a lot of people hold oil companies in their portfolio primarily for dividend, which I get, but if those dividends continue to be cut or suspended, I really do believe your money is better allocated elsewhere. There are still some sectors which will most likely be safe from potential disruption, areas like consumer staples and discretionary. People always need and want things like food and toiletries, clothes, albeit we should be keeping an eye on some of the micro trends like the reducing levels of meat consumption and whether companies like Beyond Meat continue to grow. To show you what I'm doing, I thought it would be useful to dive into my portfolio and show you what stocks I've bought to try and hedge against some of these future trends potentially playing out. So Square is the first one, which obviously we've covered. I do own traditional banking stocks, but just in case Square does start to steal significant market share off those guys, I've got it in there now. If it does do that, I will gradually sell out of some of the traditional banks and start to bulk up my holding in Square. Tesla's also in there, which is there for two reasons. One, as a compromise or as a replacement for the traditional oil stocks like Shell and BP because of its solar panel and battery storage, and secondly because of its electric cars taking over traditional combustion engines. As we move down, one of the other ones I hold, as you can see, there is Illumina. So Illumina is a slightly more speculative stock. They do DNA sequencing, which could potentially have huge benefits in healthcare and preventing illnesses and diseases before they even happen by changing people's DNA sequencing. This would have a huge effect on some of the traditional healthcare companies which produce vaccines and painkillers and that sort of thing. It would just reduce the need for those massively. Finally, 3i in there at the bottom is another play on renewable and sustainable energy. They hold investments in a number of sustainable infrastructure projects and own companies which operate and manage energy from waste plants and that sort of thing. So whilst my portfolio does include a number of well-known, established companies and brands, I am trying to keep an eye on future trends and invest in what are largely technology companies that are starting to make an impact in other sectors. They are the new breed of tech companies, and anyone who thinks tech companies are limited to FAANG stocks, and their portfolio should be as well, I personally think are in danger of missing out on some big growth opportunities. Before I wrap up, please let me know in the comments if you agree with this or not, and why. I would also be really interested to hear if you have any of the tech stocks in your portfolio that you think might disrupt some of the more traditional industries, which I haven't included in this video. Please do support this new channel by giving it a like and subscribing. It would be a great help and really very much appreciated. As I said earlier, this is the start of hopefully a very long journey for me, and it'd be great if some of you guys could join me at this early stage. Otherwise, have a great day, and hopefully I'll see you in the next one.